Hello, welcome to the Market Carver. I am Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us this week and giving us a few minutes of your time. We've got three topics for you this week. We're going to talk about factors on the international side. We're going to talk about growth versus value in Japan, so another factor-related investment point. And then we're going to hit the technical side and look at the dips that we've experienced over the last 3 months. So let's just start with international factors. And just so I say the term factors so I can bring everybody on the same page, back in I think maybe the 60s, there were a couple professors, French and Fama, created a very famous study that found a few factors that were robust and had outperformance over time. There were things like momentum, value, size, quality, and low volatility. I think those are the big five. And what's also interesting is that they have repeated that study over time in the 90s, and then again, I think recently somewhere around the early 2010s. And what they found is that those were sustained factors of outperformance. It can be a little tricky to use because it can sometimes take a long time. And you can go through a lot of years where those factors underperform. But those five get a lot of focus and we pay attention to. So as we look at the United States, we have had one factor really run away, and that has been the growth side. And it has been so concentrated on that. And so growth is not one of those five factors. In fact, it's often counterpart value is. But growth has been such a dominant factor. It's made a lot of factor-based investing really disappointing here in the U.S. and very difficult for using what has historically been a very sound investment foundation. But as we look across the globe, which in general has not been a great investment place to be, you want to be overweight the United States more times than not, and that's how we have been. But as we look at the differences, we don't see it as pronounced. The orange line is the EFA, that is the broadest reading of international holdings. And then the purple then is a weighted EFA, which puts certain weights on those factors. And you can see they are very close together, which is not the case as we've seen here in the U.S., which has been the regular index surpassing any other measurement. So that's been interesting to us. It's been much a global phenomenon as a U.S. where we've seen growth pronounced. And it's even more important as we go to the next slide in Japan. In Japan, it has been quite the opposite of here in the U.S., and it's been value trouncing growth. So Japan has been in the news recently, finally taking over its multi-decade high that they reached in the late 1980s, early 1990s, that era, depending on the index, but finally reached and surpassed those levels. So a lot of focus on Japan. That and Warren Buffett, having bought a lot of Japanese stocks in 2020, got a lot of attention as well. But it has been the value stocks. As the Japanese companies have been pressured, often by the government and exchanges, to really unlock value in the stocks. Nearly half of the companies in all of Japan were trading less than their book value, something unheard of here in the U.S. But that trend is changing, and Japanese stocks have been positive and something we have been able to take advantage of in several of our models. So, Andrew, we'll pass it over to you now and take a look here back at the U.S. and dips.
All right, thank you, Adam. So last week I did a phone call with a journalist for a major network, and they were asking, will I buy the dip when the market dips? And I said, well, we haven't had any dips. The market hasn't been going down. We've had this very steady increase in the equity market for the majority of 2024 after the kind of initial little move lower in January. But the market's been steadily increasing. We haven't been seeing any type of decline, and that's causing us to start getting a little bit stretched. We talk about this before with the market getting a little bit of the proverbial rubber band getting a little stretched. And so I want to kind of show a different way to look at that type of data and kind of look at the lack of dips that we've seen, a lack of any pullbacks, any declines in the broad index. And that's the chart I brought for this week's Market Carver. And this looks at the number of days we've gone without the market hitting a 15-day low. So we're not even looking for a major 1-month low or 6-month low, anything like that, just simply a 15-day low. And as the time you'll see this video, we'll be over 80 days of the market consistently going higher without seeing any minimal of a pullback. And that's pretty rare. You can see this chart goes back to the late 1990s. And you can see there's only been a handful of times where the streak has gone longer than we are today. The numbers on the screen, you'll see 81, 115, more recently 114, 74. Those numbers in blue show how long the streak lasted until the market finally did put in at least a short-term peak. And so you can see it has gone much longer. We've gone into the hundreds of days, like for instance, in January 2017 into January 2018, where the market continued to go higher. And we saw that parabolic move and then a 10% pullback. Most recently, after the COVID crash, we saw the market go really strong, and then it pulled back, and we had another 10% drawdown after it had gone 114 days. And so these streaks can go on for an extended period of time. Just because it's gone on for now at 80 days doesn't necessarily mean it has to stop right now, but it is telling us that the proverbial rubber band is getting stretched. We are seeing the market is going to need to have some type of consolidation likely soon to be able to work off some of this excessive optimism that's kind of built into the market at this point. And like we've talked about on previous market carvers, drawdowns are normal parts of the market environment. Typically, we do see a 5 to 10% drawdown at some point just about every year. And so it's just a matter of kind of when those types of periods or opportunities, as they often can be, present themselves, and we can reevaluate within portfolios, maybe take advantage of some short-term weakness. But it's pretty amazing to see the streak now. Again, we're breaking 80 days this week of how long we've gone without even just a minimal pullback in the large cap equity market.
That's great. That's great. And hey, we'll take that trend. Certainly compared to what we had in the months prior to that. But yeah, thank you as always for the update, Andrew. And thank you to all of you for giving us your time. As always, we give you a reminder to give us a call if we can be of help. 800-928-4001 or scan the QR code and book it electronically. So thanks again. Have a great weekend.